Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the jobs report and how that data is impacting mortgage rates, even while the markets are still digesting very significant tariffs. Logan, welcome back to the podcast.
We're saying it again. Wow, wow, wow. It's what a week. This really escalated out of hand pretty quickly.
We are recording this.
You know what's funny, Sarah? You know what's funny? That's from Anchorman, and usually the next line is like, he was telling one of the characters, "Man, you had a grenade in your hand," and a bunch of anchors got in a fight, and all the anchors from all the other networks came, and people were throwing tridents and nets and blowing people up, and that's kind of this week. So for everyone listening and watching, think of Anchorman and the fight scene, and of that. That's the last few days since the tariff were announced, and it does look like my kind of assumption that when I saw the first tariff thing, I just laughed, like, "What's that?" And then it looks like all the kind of the main people that Trump brought in to design kind of tariffs and percentage, he threw them all out, and he said, Peter Navarro, they just got a bunch of numbers and they went with it, kind of at that stance. And that's why it was aggressive. And now Peter Navarro from UC Irvine, I live in Irvine, so now it makes sense to me. Now that whole thing makes sense to me more now. And here we are. It's Friday morning. The 10-year yield, guys, like, I keep on, like, every 20 minutes I check, and like 3:47 a.m., the 10-year yield took another dive lower. China did their retaliation. Everyone kind of knows that's happening. And then stock markets are selling off. We are talking about Friday morning. This is a few hours after the jobs report. Lord knows that something can change within 10 minutes after I talk right now. So who knows by the time this podcast comes out Monday. But we clearly have a set of variables that we know and the actions that occurred this week, and time to move on forward with the next chapter of this book.
No, this has been a very just a wild week, but even just today. So like you said, it's Friday morning, and the crazy thing is the jobs data came out, and yes, we're seeing, the 10-year yield go down, but we haven't seen mortgage rates go that low considering.
We did have the year-to-date lows on Friday morning. However, the spreads are getting worse. And if the 10-year yield slowly moved down, let's say, okay, so let's go with my 2025 forecast. The 10-year yield peak was 470 in the forecast. The bottom range is 380. And let's just assume things were calm and slowly the 10-year yield moved down, and the economy was just moving in the same direction. The Fed did some rate cuts. We could have had the 10-year yield go down, mortgage rates go down, and spreads kind of get a little bit better. Here, just the last, 72 hours, all hell broke loose. That was a waterfall dive. And whenever you get that kind of action, the spreads typically get worse. So even though mortgage rates are at the year-to-date lows, the spread has actually been bad during this period of time as well.
I think it's crazy because when we were on the podcast yesterday, because we do a Thursday, Friday back-to-back, you said, labor looks right to you. Labor looks about right to you. And you didn't think that like anything could happen. But actually, the jobs report, it beat.
If there was no tariffs this week announced, the 10-year yield is 4.35% or maybe even higher. Jobs week itself, job openings data, fine. The labor market's getting softer. We could see that. But even with all the headlines and the concerns of what's going to happen, still okay. ADP report, we don't really care about that, but that did beat estimates. Jobless claims tick down. The continuing claims factor is picking up there. So naturally, it's a softer market in that sense. Not breaking, though. And here's Jobs Friday. Beat estimates. We did have negative revisions. This is probably going to get revised lower out in the future, but still intact. And if I'm a labor over inflation, labor market has to break kind of person, this is not breaking data. But it also, to me, at least this is my assumption, emboldens President Trump to really go aggressive, because he has a little bit of time before the labor data, because you can't do this if the labor data was breaking and the 10-year yield was higher. And you're pushing yourself. So we will see what will be announced over the weekend, next Monday, over the next 2 weeks, 30 days. But the only reason bond yields fell, the only reason stock, this is a tariff thing. This week, the economic data was fine on the labor side. There's a series of other data lines that are getting weaker, right? Retail sales, new orders, ISM. There's a bunch of other things that have been getting weaker. The GDP numbers, even you make the gold adjustments and trade adjustments, still negative. But the labor data, I thought, is holding, and the tariff thing just blew it, right? Because remember, 65 to 75% of where the 10-year yield can range in mortgage still Fed policy. And Jerome Powell even talked today and kind of said, listen, this is a little bit maybe more than we expected on tariffs, and we're going to wait and see what the implications are. We are modestly restrictive right now, so if anything happens, we'll act. But this is not a labor story for this week. There are other economic data lines that are getting softer, and it warranted yields to go down off of it, but it's not because that we're losing jobs or anything like that in a bigger fashion. The unemployment rate did tick up. Big theme of our work this year is that if everything stays constant, the unemployment rate will tick up. So that has legs to keep on going higher. So we just have to literally take this I have to say that every second, because you don't know what's going to get announced. I'm saying this Friday morning. By Monday, when this podcast comes out, it seems like 3 eternities of life can happen during that time frame.
Okay, let's talk about within the jobs report itself. You're always looking at the construction workers data, especially single family residential construction workers. What did this say?
Slight growth, right? It wasn't anything spectacular, but the construction data itself. Now there's construction workers, and then there's the residential side of that data line. But construction workers grew, residential constructors grew slightly. So that traditionally falls. Like we see a noticeable decline, then the recession happens. So this is why I'm keeping an eye on that. But again, it's not about the labor data this week. There is just about the economy. And also today, not shocking, Trump went after Powell. Fed needs to cut rates. Fed always cuts rates very late. They're always late. Sarah, they're always old and slow. So in any case, regarding this, I think it just becomes a little bit more tricky for the Fed. Like, what are they going to do if they're going to sit back and wait? But I think just like Trump has a little bit of time, wiggle room to try to get deals done, Powell has a little bit of time to like hold back and see what happens. And he doesn't want to go full. I mean, the 2-year yield was just collapsed. I think we're at 3.5. That means, market's almost pricing 4 rate cuts now. And we see this every year. There's always a growth scale. This is a little bit different, right? This is a huge titanic shift, policy change. So you be careful, because literally President Trump could say one thing, the 10-year yield could go straight up. Stock market could rebound, right? And it could be very sharp and fast. So everyone kind of be mindful of that. You have to be aware of everything. And if you need someone 24/7 who's your chart daddy nerd, follow me on Instagram, because we just track this stuff religiously, and literally we try to keep people posted. But this is a very, very violent time. And as we did when the 10-year yield was at 5%, and we're staying up at 2 o'clock in the morning doing 10-year yield charts, while everybody's probably having fun. Here, it's such a violent move to the downside that any kind of news can flip this very quickly. So be mindful of that, those who are in the mortgage and real estate industry, that this kind of volatility is not normal. And if the economic data doesn't get weaker or whatever's creating this, which we know is the headlines around tariffs and the tariff policy itself, if that changes, yields can go up, because the labor data didn't necessarily break this week.
Which is crazy to me, because, everyone would feel like, I felt like, if the stock market is going down so much, we've got 10-year yields going down so much, surely this means way lower mortgage rates, and you made
it is. I mean, we have the lowest mortgage rates of the year. It's just the spreads did not I mean, I would tell you this. If we had the good spread curve, you're probably looking at 15 basis points lower. So it isn't like mortgage rates haven't gone lower. I think the thing is, people think if you're going into recession, the 10-year yield should be right at that Gandalf line. And I understand that, right? That's why we held the Gandalf line, for those who don't understand, in 2023 when the Silicon Valley banking crisis happened. The Federal Reserve got in. Everybody thought we were going to recession because of banking crisis. They cleaned up everything. Now what we're seeing is people are starting to worry about credit. So this is a little quick mini introduction into credit cycles. If corporates don't get debt, if IPOs get pulled back, people don't want to invest, you can't do any secondary to raise money for your company, that is not a good sign for the economy. So people now, for the first time in a while, are starting to worry about this. This is all the headlines and everything. This is what drama happens. And we always say itchy fingers, right? Bond traders, middle-aged men, podcast stock traders, right? The itchy fingers. So this is why this is not normal action right now.
With this jobs week, now we're done with jobs week. We've gotten all of that data. Is there anything coming up next that could make this go lower or higher right away?
Usually after jobs week, it's inflation week, so we have CPI inflation and PPI inflation, and, oil prices fell. It broke its Gandalf line for the first time. It's chaos, Sarah. It is absolute chaos. And it's hard to try to entangle monthly data into something that's happened within hours, right? Or the implications of it going out, because this thing just happened. So we have inflation week, but inflation week is data from last month, and all we know is that the tracker, Chart Daddy's HousingWire tracker, has shown that the one sector that's actually done good, purchase application data, I'm not talking about existing home sales booming or anything, but it has been positive. It has a much lower bar than the new home sales market, right? The new home sales market is still at 2019 levels. It's got supply and profit margin issues. But here, actually, one thing that I got wrong, we had talked about how much do the builders import percentage wise that goes into a home? I thought it was like 9 to 11%. It wasn't even that. It was 7%. The builders came out. So 7% of what the builders put into a house gets imported. So a little bit of context. So when they say that the cure for tariffs is lower rates, the builders, in the sense mortgage rates going lower, more demand, that explains what happened during COVID, right? We had $1,600-$1,700 lumber prices, right? But mortgage rates are lower. So if you're trying to see why Trump and the White House and Bassett and everybody wants lower rates, if there's one thing that can mitigate all this headline, it would be that. But again, that's just the real estate sector out there. There's other aspects of the economy.
So you've been talking all along about how, if he wanted to do, these big tariffs, he would just put them in. There would be no negotiation. So we've already seen, I think, Vietnam make a deal, right? So what's going to move the needle? What could move the needle for home builders right now?
I mean, here's the thing. It's, if you're talking about housing, rates override everything. If you're talking about the trade war, if you start to get a few countries doing deals, okay, that at least shows you there's a pathway. Canada and Mexico are our big partners, right? So the builders, as you can imagine, are probably not happy with cost, but quietly. And this is why the builders next survey, I want to keep an eye on this. Last builder survey, everything fell except the forward-looking builder survey, the 6 months out, the sales thing stopped declining. So if that actually picks up in the next month report, because rates have gone lower, the builders feel a little bit more confident, right? Housing is one of these things that, again, simple answer is it revolves around the 10-year yield. So we've had a noticeable drop in the 10-year yield. We're like 7 basis points away from my forecast low. That's how crazy it's been the first 3 months. But here, I think the builders would just love lower rates. I think they could handle maybe some of the tariff costs, but I just think everything is just, people just don't know. They're confused. They don't know what the rules are. Is this going to be it? Are they going to do deals? So until you get clarity, and if
Yeah.
I'm wrong, then Trump just sticks here and has these tariffs, and we never negotiate anything. But I'm assuming the way he did it, and now that I know that Peter Navarro did this, and it all makes sense now how chaotic this was. A little bit more hopeful that you get a little bit more clarity on this going on in the future. I know a lot of people out there are saying, this is it. This is going to be the change, everything. Let me tell you something. Politics. Oh my. Y'all don't know how powerful that is. We've got Republicans in California and New York doing SALT increases, which helps homeowners. Why? Because the Republicans have a little bit more leverage now because of the House seats, or not that they don't have too many House seats they could lose. But eventually, what we saw is like the Senate actually stopped, the tariffs from Canada, but the House didn't. There are pain points to where you could see maybe Republicans drop off and then try to regulate Trump. But here we are. It's just a few days, and you can see the chaos that happened. And for those that don't remember, in 2018 and 19, this was kind of the case. It was much smaller tariffs back then. The Fed funds rate was lower. The growth rate of inflation wasn't breaking out. It was actually heading lower. So interesting times, Wheeler.
Listen,
Just interesting times.
in 2018-19, penguins were safe. No penguins were being taxed.
Yeah.
No penguins had tariffs being levied on them. I think you hit on something here when you talked about volatility, because a lot of the stories that I read this morning in the mainstream press were about the fact that people kind of said, okay, on April 2nd, we'll get some clarity. On April 2nd, we'll all know, and kind of like, okay, we can go from there. And kind of what you said earlier this week, we're like, if it was just the 10%, if that very first level that he did, it was like, oh, okay. I mean, it has its things or whatever, but it didn't stop there. And I think that's what has surprised people, is that there was that whole extra level.
Again, when the 10% tariff numbers came out, bond yields went up, stocks went up. Okay, that's your cue for the market saying, okay, this is something, whatever it is, we could work with it. When they brought out the Godzilla tariffs, everyone's like, oh, Nelly, goodbye, see ya, elevator, drop it down. So the markets are the markets, man. This is just a way, but you cannot, try to control this thing. There's way too much money, way too many different players, and you can see what happened this week on Thursday and Friday. Again, what we know already is that this can change, right? One or two sentences and things can move. So I caution everybody, this is not normal periods of times. If the economy was crashing and jobless claims are up and unemployment rates are going up, it's the 10-year yield has room to go lower. But here, it wasn't the labor data. We have other softer economic data. This is tariff. So be careful out there, because something can be said and it changes, and you don't want to get caught off guard here.
I think that's the hard part too, though, is because if the labor data doesn't change, in a couple of days, right? I mean, Powell's taking his approach. It's not going to be like, oh, in 3 days this could all change. I mean, if we're waiting on the labor data, that's at least another month before we get any of that data again.
You could see it through the jobless claims, but again, we have 162 million people working plus, and 4.2% unemployment rate. The history of U.S. economics, people will be like, "Oh my God, that's awesome!" Right? Jobless claims are low, job openings are high. That's a healthy market. It's just now we have other variables that people are looking at in the future. So, there are. Yeah, I think Nintendo Switch delayed its release because of
Yep.
tariffs. So there's just things that it's just going to be crazy, right? And we're going to try to make sense of it all. But for housing, for everyone here, positive, right? Positive story, because rates go lower. And before rates broke that 6 point, we are now in the area where housing data actually has improved once I take the seasonality, when we're under 6.64. And this is occurring after we've had the positive year already in purchase apps. Now, purchase apps are record low levels still. It's nothing spectacular, but it's for the first time in many years. So it gets interesting for housing. I know a lot of people are like, what is, oh, why? The purchase apps were good, but with elevated rates, now what? So you can see, again, the game plan of trying to get the Fed to cut rates and lower mortgage rates, right? Oil prices are down. So if you look at it in that concept, the two things they wanted to occur kind of have happened, right? Lower oil prices, lower mortgage rates. We'll see. We'll see how it goes. They're very volatile on commodity prices, but and the dollar has come down. I'm sure the Trump White House economic team is happy that the dollar's down. Dollar too strong, not good for their playbook. We talked about that the day after Trump won. So interesting. You try to play the guy and see, what poker face he has or what poker words he has, and we will take the economic data one day at a time.
When you're looking at playing the guy, I know you're talking about Trump there, but if you're looking at Powell, how do you? I mean, the pressure is intense right now more than ever.
I don't think Powell. I think in some ways Powell goes, "Hey man, this is you. This isn't us. We did our soft landing. We got the growth rate of inflation, even though it's not him. It's really pandemic disinflation, but we got it here. We were going here. You brought this in." So in some ways, I think Powell says, "Hey, I got the Trump cover, right? He's the one begging me to cut rates. He's the one who's doing the tariffs." So I think in some ways, Powell thinks, "Hey, listen, I can't control the guy. I just got to sit." The problem, what Powell might have, is when jobless claims start to break. Then that's different because that's part of their dual mandate. But for now, what he said this Friday, talking about we are mindful, we're modestly restrictive right now. If we need to act, we will. But we want to anchor inflation. These things are not like, "Hey, I'm about to cut rates for you, homie. Let's go." But it's different now, and it's different than the 2018-19 fight with the Fed. The growth rate of inflation was falling in 2018 below target. We're not having that now, so it's a much different time.
You brought up the Silicon Valley Bank crisis in 2022. Right? 2022 or 2023?
2020. It kind of started late 2022, but 2023 is when all the action happened.
Okay. So, and it was like, we're talking on Friday night, you're writing things on Saturday and Sunday. And I'm like, that's just normal now. Now it's just normal that we have to do this.
Now we have a lot of action. And just remember that it's very, very critical that the credit markets work. If the credit markets start breaking, that's a terrible negative sign. So far, credit has behaved very well to people that are so surprised about it. But now the credit markets are showing some stress. So we'll see. I mean, who knows, Sarah? By the time we're end of this podcast and I go back on Twitter hell, things might be different. But this is not normal. Everyone realized this is a very, very wild, volatile time, and people are just trying to make sense of what the real policy is going out in the future.
Appreciate having you on as always. I am going to be taking a break for the next couple of days. You're going to have another host here. So you
should just have me do my own show. Come on. You should just have Logan unleashed by himself for 1 week.
Absolutely
I don't get
not.
1 week. I could imagine what I could be like when you're not here and not regulating me. I would be so much fun. I want everyone to email Sarah Wheeler at sarah@hwmedia.com and say, give Logan at least, a few episodes where you're on vacation where he could just be himself.
Oh my gosh. No, that's you on Twitter. If people want that, you are already there on Twitter and Instagram. And yeah, no, we're not doing that. No, I appreciate you so much. Thanks for giving us the latest because things are crazy. And it's really nice to know someone's watching it so closely and giving everybody the information that, as much as anybody can do it, you are tracking it. And, everything, every day that we meet, we talk about this. The next day, it's like, you were right about that. Oh, this is what you said was going to happen. So pretty great. Thanks for being on.
My pleasure. I love this stuff.